Hello everyone, I'm Yang Dini. Today, our group will present an evaluation of solar tech. Despite being part of the renewable energy industry, solar tech faces two key ESG challenges: high carbon emissions and a lack of workplace diversity. To respond, solar tech plans several initiatives from 2025 onward. So we will assess whether these actions are both financially viable and aesthetically sound. Firstly, Dini and Chuxuan will calculate the break-even points and evaluate two separate cost recovery strategies. Secondly, Fengrong and Chunyu projected cash budgets from 2025 to 2027 and conduct relevant analysis on it. Then give managed strategies. Finally, Zhao Guang will consider a series of ethical reflections. Ultimately, we aim to assess the financial and operational sustainability of the company after it has faced ESG challenges. Okay, well. Firstly, after our calculation, the calculation results show that the current break-even is 1.4 million units, while SolarTech sales are 2 million units. That indicates that SolarTech current sales are more than the break-even. Therefore, they can cover all the costs and gain profit. So the company remains financially stable. However, the differences between sales and the break-even points are small. So the company is sensitive to the cost or sales volume. So the company is sensitive to changes in cost or sales. If consumer demand drops or cost rise, SolarTech could fall below the break-even point and face financial problems in the future. And then, after implementing ESG complaints, we can get the new break-even volume. The company allocated 1.4 million to solar energy and efficiency upgrades, and along with 600,000 to diversity and inclusion initiatives. And SolarTech's break-even point rise to 1.8 million units, which means the company now needs to sell more products or services to offset its cost and achieve profitability. Therefore, that indicates SolarTech faces higher financial risk if its sales drop or its expenses rise further. And we are assessing whether the current annual sales volume remains adequate now. According to the calculation result, because 2 million is larger than the 1.4 million and 2 million is larger than 1.8 million, we can know the current annual sales volume is greater than the current break-even volume, even after implementing ESG compliance measures. Hence, the current sales volume is adequate. That means the sales not only cover all the costs, but also generate profits. Next is Chuxuan.
Now let's compare the two cost recovery strategies and their risks. In scenario A, the selling price increases by 40 cents per unit, raises profit to about 1.8 million ringgit, an 80% increase from original 1 million ringgit. In scenario B, raising sales volume by 12% without changing the price increases profit to about 2.2 million ringgit, or 120% higher than before. Now let's move on to the risks for each scenario. From a financial view, scenario B gives higher profit, but also more pressure on marketing, production, and inventory. Scenario A is easier to apply, but may reduce customer demand because of the higher price. From a non-financial view, scenario A may hurt customer satisfaction or brand image, while scenario B could cause employee stress or quality problems if production grows too fast. Overall, compared to scenario A with an 80% increase, scenario B provides the highest expected profits of about 120%. It also supports stronger long-term growth and fits better with SolarTech's ESG goals. Thank you for listening. I will pass it to Fengrong to continue.
In this section, I will present Scholar Teach cash budget focus for 2025 to 2027 and highlight the cash surplus or shortage during its ESG complete phase. This analysis helps us understand how the company liquidity evolves while pursuing sustainability goals. Starting with the 2024 baseline cash inflow were 20 million and operating payment were 16 million, leaving an opening cash balance of 4 million for 2025. For cash inflow, revenue is expected to decrease by 5% in 2025 to 19 million due to worker demand, increase by 5% in 2026 to 19.95 million as market confidence returns, and risk by 7% in 2027 to 21.36 million driven by ESG-related contract. For cash outflow, operating payments are projected to increase by 40% in 2025 to 22.4 million, a surge partly reflecting the initial impact of supply chain adjustments among ESG preparation, plus one-off ESG compliance cost of 2 million. In 2026, operating expenses fall to 19.2 million, 20% higher than 2024 as supply chain cost control take effect. With no additional ESG cost, making total outflows 19.2 million. In 2027, operating expenses increased by 5% to 20.16 million for routine maintenance and D&I related expenditures, with total outflow remaining at 20.16 million. In terms of net cash flow, 2025 will see a net cash outflow of 5.4 million, leading to a cash shortage of 5.4 million. 2026 will achieve a net cash inflow of 0.75 million, narrowing the cumulative cash deficit to 0.65 million by year end. 2027 will realize a net cash inflow of around 1.19 million, finally returning to a positive closing cash balance of 536,500. In summary, 2025 represents a significant short-term cash strains due to one-off ESG investment and high operational cost, resulting in a 5.4 million cash shortage by 2026 as energy saving and efficiency measures take effect and cost decline. The company transitions to meet modest net cash inflow, easy cash pressure by 2027 with continued revenue growth and stable operating expenses. The company achieved a healthy cash surplus, making a positive turn in its cash flow structure. Overall, Scholar Teach cash positions shows a positive long-term trend, where short-term company's investment led to foundation of sustainability, financial growth, and resilience. Next is Chunyu.
I'll be presenting our analysis of SolarTech cash flow sustainability during its ESG compliance phase. From 2025 to 2027, SolarTech went through 3 stages: short-term pressure, mid-term recovery, and long-term stability. In 2025 marked the strongest liquidity crisis period experienced by the company. This was due to lower cash received of 5% to 19 million, while operating payments surged to 24.4 million, with 2 million of which was related to ESG. As a result, the year ended with the company facing a cash deficit of 5.4 million, with the operating cash ratio standing at 0.78, indicating that the short-term debt repayment capacity is limited. By 2026, the situation improved. Inflows rose to 18.85 million, expenses fell to 18.2 million, and there were no additional ESG fixed costs. The company's net cash flow turned positive, reaching 750,000, and the operating cash ratio improved to about 1.04. This is a clear sign that SolarTech has restored its equity and regained its ability to meet cash obligation confidently. Finally, in 2027, stronger market confidence and ESG reputation drove inflows up by 7% to 21.35 million. Operating expenses increased only by a small margin of 5% to 20,160,000, and finally broke even with a positive cash flow of 1,186,500. This means that the efficiency of cash flow in the company's operations has increased sharply, and the operating cash ratio has rebounded to about 1.06. This steady recovery shows that SolarTech has built a sustainable financial cycle, transforming ESG investment pressure into long-term financial resilience. Although the company reached a surplus in 2027, short-term liquidity risks remain. To manage these challenges, we recalled a strategy focusing on internal efficiency and external financing. Firstly, under internal cash optimization, we'll reduce the credit term of customers by 15 days, thereby cash flow by 2.5 million, which is about 12% of our working capital. After that, we'll also extend payment to our suppliers by another 15 days, hence reducing our short-term cash outflow by 1 million. We'll upgrade our energy efficiency equipment, as well as automate process that will result in a savings of about 615,000 yearly. This is compressed of savings of 400. A rolling cash forecast on a quarterly basis will also offer a warning of any possible deficit that is 13 days earlier. For external financing, SolarTech will apply for green or sustainability-linked loans with interest rates of between 0.5% to 1% lower than before, thereby saving around 100,000 per year. We'll allocate a cash reserve of about 10% around 2 million, as well as allocate our ESG fund into this 3 years to reduce the effects in 2025. Finally, have multiple source of funding can help reduce dependence on one bank. Together, this above mentioned steps ensure the sustainability of the library in the long term. With these combined measures, SolarTech can not only overcome short-term cash pressure, but also maintain strong, sustainable cash flow in the long term. So next is Zhao Guang.
I'm going to present an ethical reflection regarding the ESG practice of SolarTech. Let's first look at specific ESG challenges SolarTech faced and their direct ramifications. SolarTech had a serious environmental issue. It relied on coal power, which caused very high carbon emissions. To fix this, the company invested 2 million ringgit in solar panels and energy-saving upgrades. This raised operating costs a lot. And the company had a social issue as well. Its workforce lacked diversity, as only 15% of its employees were women. Most leadership roles were held by men. To address this, SolarTech launched diversity and inclusion programs. This also added extra pressure to its operations. So, what were the main impacts of SolarTech's ESG challenges? First, the company's reputation was damaged. Some clients said they might stop working with SolarTech if it did not improve emissions and diversity. Second, the company faced financial pressure. It spent $2 million on ESG reforms, which increased the breakpoint from 1.4 million to 1.8 million units. Third, sales dropped in 2025 due to lost trust. Cash receipts fell by 5%, and the company faced a short-term cash shortage. However, the long-term effects were positive. In 2026 and 2027, customer trust improved, sales increased, and cash flow turned positive again. In short, the ESG challenges caused short-term pain but led to long-term recovery and stronger performance. For the next part, we'll talk about the risk of delaying ESG reforms. Now, given this financial and reputational pain, what could happen if SolarTech delays ESG reforms to focus on short-term profits? For instance, it may lose customer trust in the future contracts, leading to lower sales, weaker cash flow, and higher long-term financial risk. For example, if sales growth slows by even 2 to 3%, the expected cash surplus in 2027 would become negative completely. Moreover, without ESG improvements, SolarTech may miss the chance to get green loans with lower interest rates, raising financing costs. Furthermore, avoiding ESG reforms may also hurt SolarTech's reputation and operations in the long run, leading to bad publicity, weaker brand value, supply chain pressure, and talent loss. Fixed costs do not change with sales, so if revenue falls, those costs still need to be paid, increasing the risk of cash stress. In the end, we recommend the path forward to balance both financial recovery and its ESG duties. So how should SolarTech balance this dilemma between financial recovery and its ESG duties? First of all, SolarTech can increase sales by improving marketing, offering bundle deals, or targeting new customer groups. For example, in scenario B, this 12% sales growth brings more profit than raising prices. The extra income helps cover ESG and D&I costs without losing customer demand. This way, the company stays competitive while meeting long-term goals. Next, SolarTech can save energy by upgrading to LED lights, using solar panels, and automating equipment. These changes lower electricity bills and reducing emissions. With lower costs, the company can reinvest in growth and meet ESG goals at the same time. In addition, SolarTech can build fair systems, such as using blind resumes, applying structured interviews, and setting clear promotion KPIs. It can retain employees, attract new talent, and improve overall working quality. It cannot only support the inclusiveness of the workplace, but also make productivity more efficient and help restore long-term profits.
Right. In conclusion, SolarTech continues to make a profit while meeting its ESG goals. Even with added ESG and the D&I costs, sales still cover the break-even point. Scenario B gives higher profits and better long-term growth by increasing sales. Scenario A is easier to apply but only helps in the short term. Although there is a cash shortage in 2025, cash flows turns positive in 2026 and improves in 2027. This shows that ESG reforms are not just costs, but long-term investment that build trust. By linking profits with responsibility, SolarTech achieves real sustainable growth. And here is our AI acknowledgement. Thank you for listening.